Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm going to review some key Chinese stocks. Just going to talk about some key fundamentals. There's going to be a lot to learn, and also, let's get to it. Like always, we always want to get a basic idea of what happened to the stock market and the currencies. Right now, the dollar index has continued going lower. Therefore, U.S. stocks would most likely go higher. And the previous day trading session, we had a pretty decent, trading session, at least for U.S. markets. But today we were relatively negative to flat. Asian stocks were very positive leading up to this. I mean, China was up 0.74%, making new all-time highs. But for some weird reason, we just can't get any traction in the Chinese U.S. stock market, where Chinese stocks are traded on U.S. stock exchanges. And part of it has to do with just too much demand at the IPO, therefore making those valuations a little unrealistic or unreasonable at times. Now let's start with Youku.com. Youku.com had a minor pullback, even though the Chinese markets did have a pretty strong day. Remember, Youku.com, very good company. I do believe there's a lot of opportunity coming from this company. Overall, longer term, I am pretty bullish on it. But please remember guys, at times Chinese stocks do have a pretty rough start. If you guys go ahead and look back, initially the public offering took it all the way up to $52. It crashed, landed all the way to $30, and now it's taking out its previous all-time highs and just continuing onwards. And you'll see this a lot with Chinese IPOs. It's not just 1 or 2 or 3 IPOs. It happens all the time. It's the same story over and over and over again, guys. When you guys see a Chinese IPO, people like to short them, then they cover them, and then they buy them for the long term. And you're going to see a case of, we'll actually look at a stock undergoing the same exact phenomena you're seeing with Youku.com, ticker symbol YOKU. Let's look at Ding Ding. Ding Ding, the Amazon of China, and pretty much the company that you want to be exposed to, where the world's largest middle class is emerging, where 11% of worldwide consumption is currently being done. It's going to soon have the biggest population of middle class. Therefore, a lot of people in the middle class, especially in the United States, loves to shop on Amazon.com. I mean, it's just so convenient. You sit in front of a computer, you type in a couple numbers, you type in some words, and you can find the product you want. You don't have to go strolling around a mall all day looking for some product. You just type in some words, you find the product, and then you buy it. Simple as that. But it doesn't matter. It doesn't matter to the general investment public. It doesn't matter how great of a company you are or the prospect you hold. For some weird reason, you see these Chinese tech stocks time and time again. They just love to sell off after an initial public offering, and eventually they bottom out and they find a reasonable valuation where investors will start to buy into them. They start taking a nibble. They start eating on that golden fish. Eventually, it becomes a golden fish, and we'll point that out to you in another chart later on in this video. But again, Ding Ding, great opportunity. My favorite tech pick for 2011. But remember, guys, remember, until the price is right for these people, they're not going to buy into it. It's going to take time. And even at these valuations, I still like the company, without a doubt. But people are still going to keep on selling them, and they're probably going to go a little lower later on in the future. But years down the road, this is your best exposure to the Chinese consumer. Because we all know the same story. We all know what happened to Amazon. That was history. But we want to be able to get exposed to the same exact phenomena coming from Amazon, but in China. The Chinese Amazon, the Ding Ding. That's where it's at. I think that if you guys can get exposure to this type of stock before all those, above all, if you get exposure to this type of stock, it already has revenue, it already has a decent net income, and its growth is phenomenal. And it will continue to be that way. But it's just going to take time for you to get back to those IPO levels, where it initially starts off at $32 per share, $36 per share. And a lot of times what happens is that people are very convinced at the IPO These companies go on campaigns promoting what they do. This is why we have the best product, best opportunity, this, that, we're exposed to the right market, blah, blah, blah. But over time, people lose their reason to buy into the company. And eventually people like to come back into it. The earnings continue to keep on blowing out, and they say, hey, maybe I'm missing out on something. Maybe I should come back into this. And that's what you're going to eventually see. But for right now, don't be surprised if it goes a little lower. But if you want to buy into it, you probably want a dollar cost average into this type of company. Next, Sohu.com. Sohu.com was a little different. I think with Sohu.com, what you basically had, if we go ahead and look at the max chart, you guys will notice that Sohu.com has been around for a long time, guys. A long time. Ever since 2003, now it's 2011, it's breaking all-time highs. Chinese markets are making new all-time highs. Therefore, you could always imagine Sohu doing the same exact thing. Now I'm going to go ahead and clear up the trade triangles, and I'm going to go ahead and show you guys something. I'm going to go back all the way back into the past and just look at what exactly happened in April of 2003. And this is just going to take a quick moment of your time. But you guys are going to notice that this stock did start off very, very strong. And the main reason why is that people didn't really see any value in it at the very outset of it. Over time, people saw value in it. But at the very outset of it, nobody saw much value in it. And that's what's important, guys. You guys have to realize that it started at 12 bucks per share. It was worth less than $100 million at the time. And right now, a lot of these Chinese IPOs are coming out at 1.53 billion bucks. So again, people didn't think there was, at the very outset of it, there wasn't much promotion, there wasn't much of anything. And besides, it was 2003, after the internet bubble bursted. Nobody was going to buy an IPO, a Chinese IPO tech stock, blah, blah, blah. Who cares? They're just going to ignore it. They're going to say, hey, who cares? It's a Chinese IPO, it's a tech stock, internet stocks. We've heard of those before. We don't want them. We've lost enough money on them. We're not going to get exposed. And of course, when you have that type of mentality instead of a stock, it has only room to go higher as earnings improve, as performance improves, and as the market, as the forecasts generally become rosier for the Chinese economy. So did this company. So again, different circumstances. Now let's look at the next stock, which is going to be Baidu. Baidu is not Baidu, this is QQ360. QQ360 is a company just like a lot of other Chinese IPOs. They start off at a really, really high valuation. I mean, this company only makes $8.5 million in net income annually. And pretty much what happens here is that, again, great product, great market, great consumer base, blah, 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 great, great, great. Okay, but at the same time, everybody likes to sell these Chinese stocks on the days open. I don't know why. It just turns out to be that way. And I could see QQ360 dropping down to around $18, maybe $15 per share for like maybe a couple years. It could stay in the $15 to $20, lower $20 range for up to 3 years until eventually it turns around, earnings are great, and then people are saying, hey, I'm missing out on something here, I gotta buy into this, blah, blah, blah. So over the short term, I honestly think that if you short this stock, you will make some decent money. But over the long term, you want to hold on to a stock for 10 years or something, you wouldn't short this stock thinking that you would make a fortune off it because it'll go bankrupt. No, that's not the stock. That's not the type of stock this is. This is a type of stock that has a tendency to have a strong IPO. It falls down drastically. Eventually, it goes back up to IPO levels, and then it surpasses it because earnings continue to be great. China's economy is inflating at a ridiculous rate. Therefore, growth is going in at a ridiculous rate. And of course, companies like QQ360 that make antivirus software on top of having a web browser are the type of companies you would want to be in. Chinese tech, I believe, is where the action is going to be at for the next decade. All right. Moving on, let's look at Baidu. Baidu did have a pretty strong day. It had a minor pullback. It fell down to 135. It made it right back up to the $141.83 area. And then, of course, you see this break below this, right at this trend line. That was your signal. That was when a lot of people went went ahead and bought in to the Baidu. Now, I want to go ahead and zoom back into Baidu as well, and I want to see, do we get that same exact phenomenon? Do you see stocks, even like Baidu, do a poor job of generating returns in their first year Absolutely, and I'm going to go ahead and show this to you guys as well, and in much needed detail. I'm just going to go ahead and go to September 30, and pretty much you guys will see right here. Boom, all the way up to $15. It falls all the way down to $5, and guess what, guys? That's a 75% decline. All right, that's awful. That's as bad as it gets, guys. But now, if you guys go ahead and look at the 10 5-year chart, Baidu was at $141. So you guys get a basic grasp, but these Chinese stocks at their initial public offering, very, very easy short opportunity. You can make a lot of money, at least on the short term. But these aren't the type of companies that will go bankrupt. Rather, over 10 years, these are the type of companies that will make you a fortune. So again, short term, short, long term, buy. That's basically all I can say about these IPOs. And the one that I'm pointing out is QQ360 and Ding Ding. Those are your big IPOs of 2011, and that's where I think the opportunity lies in the next 10 years. Take care, guys. If you guys want to use the same trading software, check out the link right below this video. Subscribe to this channel if you guys are interested in this kind of stuff. I'll have more for you in the coming weeks and months ahead.